Peace, guys. What it do? This is the Price Action Chunky here with another presentation. And in this demonstration, we're going to be discussing margin and leverage explained. And there are going to be some key concepts that'll help you further gain a foundational conceptualization of trading in the forex markets. Let's get started. So we want to get started off by discussing lot sizes. And lots are increments used to measure the amount of money leveraged on positions in volume. Lot sizes is the amount of money you decide to put up on each position. So this is also known as a trade size. And lot sizes are categorized in micro lots, which is the smallest position allowed. And these are 0.01 to 0.09, which also means this is 1,000 to 9,000 units of currency. It's not necessarily 1,000 to 9,000 United States dollars. It is if you're trading United States dollars, but let's say if you're trading Great British pound, it is also 1,000 to 9,000 units of Great British pound, Japanese yen, and so on and so on. This is also equivalent to $1 to $9 per pip, a micro lot. Then you have mini lots, which is the second largest position allowed. And this is a 0.1 to 0.99. And this is equivalent to 10,000 to, excuse the typo, it should be 99,000 units of currency. And this is also equivalent to $10 to $99 per pip. And finally, you have a standard lot, which is the largest position measurement allowed. And this is a 1.00 and above, which is equivalent to 100,000 plus units of currency. Also equivalent to $100 plus per pip. So you can see that with these different size standards, you can leverage various amounts of money, and it doesn't take much, right? Even with a micro lot. You see, a lot of people want to trade standard lots all the time, and they don't really take into consideration how much volume they're really trading, because they are really being allowed to actually manage much larger positions than they think. So that's why it's important that I notated the amount of units of currency. So you're wondering, how can you place 0.01? How can you risk $1 per pip but still be managing a 1,000 unit currency position? And I'll explain that in the next slide. The reason that you'll be able to manage such much larger positions is because of leverage. Leverage is the use of borrowed funds to increase one's trading position beyond what would be available from their cash balance alone. Meaning, leverage is fronted money by your dealer. So your dealer will front you or cover you capital to allow you to manage larger positions. Now, the most common leverage sizes are as follows. You have a 1 to 50, which means that your dealer will front you $50 for every dollar leverage per position. 1 to 100, your dealer will offer you 100 per $1. 1 to 200, you will be offered 200 per $1 leverage. 1 to 400, your dealer will offer you $400 per $1 leverage. And 1 to 500, your dealer will offer you $500 per $1 leverage. So it is through leverage that we are able to manage larger positions based on these units of currency. So it's something that your dealer has actually wonderfully, giving you the ability to do. So that's why it's important to know that trading Forex carries a very, very high level of risk. And that is why you don't need to be greedy and always necessarily go for the 1 to 500. While, yes, it will allow you to maybe flip an account or to gain massive profits, but the balance in that is that it will also allow you to take massive losses. So that's why you don't necessarily need to be greedy. because a 1 to 50, that's $50 for every dollar leverage. That is a lot of money. Don't take that for granted. You have to be able to show gratitude and be able to show that you can handle these smaller gains before you ever be able to allow to handle and manage much, much larger positions. So keep that in mind when you guys are thinking about leverage. Now, let's talk about margin. See, margin is the minimum amount of money needed to open a position. Margin is what's considered like your down payment for the front end money that your dealer is going to give you based on your leverage. It's like a good faith deposit. It'll be something like maybe 1%, 2%, 3%, etc. Something like along those lines. You're going to have to simply have a minimum amount of money in your account in order to open a new position based on however trade size you're going for. And there's a way to actually calculate your margin. That's a question as well too. A lot of people want to know, well, what size trading account should I start with? And if you actually are able to calculate your margin, that will help you, because then you'll need to know two things. And the two things you'll need to know is the number of units or the lot size that you'll be looking to trade. And then you also need to know what leverage that you are getting from your dealer. So let's say you have a dealer that's giving you a leverage of 1 to 200. And you'll be looking to place a 0.5 mini lot or half a standard lot. See, a 0.5 mini lot is equivalent to 50,000 units of currency, also known as $5 a pip. In order to calculate margin again, you need to know the number of units and divide the leverage. So you take 50,000 divided by 200, and that'll give you $250, and that's the minimum amount of money you will need in this account, which is 1 to 200, in order to open a position of 0.5 mini lots or half a standard, or maybe various amounts of trades that are equivalent to half a standard lot. You will need $250 in this 1 to 200 account. All right, and it's that simple. So I'm gonna give you another example. Let's say you have a 1 to 50 leverage, and you wanted to be able to place a 0.1 mini lot, which is equivalent to 10,000 units of currency, also $1 per pip. So in order to calculate the margin, you would take the number of units, which is 10,000 units, and divide the leverage, which is 50, and that will give you $200. So you will need a minimum of $200 in your account if you had a 1 to 50 leverage and you want to open a 0.1 mini lot size. All right, so now let's talk about free margin. Free margin is the amount of funds available for you to open new positions. This is the capital that's used to cover losing positions. So this is why you want to make sure that keep your free margin high, so that way you will want to increase your ability to cover any potential losses that you do have in the future. And your margin level percentage. This is the ratio of equity to margin expressed as a percent. The formula to calculate your margin level percentage is to take the equity of your account, divide that by your margin, and then you'll multiply that result by 100. So let's say your equity in the account was $2,295.70, and your margin in that account size was $20. You would divide the equity. So you would divide 2,295.70. You would divide that by 20, and then you'll multiply that number by 100, and that will give you a margin level percent of $11,478.50. And the key is to also keep this margin level percentage high. And how do you keep your margin level percentage high? You keep your trade sizes low relative to your account balance, so you don't have to always be trying to max out your free margin. You have to try to max out your margin, because you don't need to get greedy, because you see that through the different lot sizes, you're gaining $1 per pip, $9 per pip, $10 per pip, right? You don't have to be greedy. That's why you also can realize you don't have to necessarily try to get the biggest swings, right? The biggest moves in the market in order to actually make and generate some money, because you want to just get consistent starting off. And then once you get that consistency, the money will come. I promise you. You never want to get in this situation, a margin call, which is a scenario in which the dealer is going to tell you that you need to deposit more money. When your screen goes red, you are over red. You are in massive drawdown to the point where, one, you can't open any positions to try to mitigate any of that loss, and two, you're really in the negatives, or you're about to be in the negative, and your broker is giving you a hint to tell you, hey, you need to deposit more money in order to keep these positions open. If not, then your broker will do you the luxury of closing your open positions. And you have something that's called a margin call level, which is the agreed minimum amount to which the margin level can fall before a margin call is triggered, which is specified by your broker. So this is going to be in your broker's account settings. And how do you prevent a margin call? Again, you keep your trade sizes low relative to your account balance. You don't try to necessarily have to have 10, 20, 30 positions open. All right. So some key takeaways is lot sizes are the amount of money leveraged on each position and volume. You have micro, mini, and standard lot sizes. Leverage is the use of borrowed capital to increase position sizes. So this is borrowed funds, right? This is the 1 to 50, 1 to 100, 1 to 200, right? This is borrowed funds that your broker will allow you to trade with in order to manage larger positions, in order for you to make a simple down payment, which is called the margin. And that's the amount of capital needed in your account to place trades or positions. Your free margin is the amount of available funds to place new positions. Your margin level percent is the calculation of equity divided by used margin times 100. And your margin call is a scenario where you have to use up all your free margin, and your dealer will tell you to deposit more funds before they close your open positions. And guys, this is a presentation on margin and leverage. I hope you guys was able to gain some immense value from this presentation. This type of information is very, very vital in understanding your relationship between you and your broker and your dealer. Because at the end of the day, the name of the game is to make money, and you first have to protect the bank. So you got to protect the bank. You got to protect your money before you can look to make more money, guys. So until then, happy trading. I wish you guys the best, and I'll see you on the next presentation. Peace.